Alright, so this video I'm going to be talking about um, how I use session projections, or how I use projections to identify um, session sponsorship, right, or institutional sponsorship for a session, right? And so this is a very important lesson because regardless if we're trading pro trend or pro higher time frame or counter higher time frame, and so this is, I guess, I'm not going to share this video with anyone. This is just for me, really just speaking through my thoughts. But if we were to create a flow chart of our thought process of how we approach the market from a top-down analysis, right? So the number one place that we start, it can come from numerous sources. It's best if it's combined with um, a higher time frame approach, such as seasonality, um, commitment of traders, um, monthly analysis, things like that. Right? Basically, what we're trying to identify is we're trying to identify a perspective with an institutional lens, right? Of trying to find those large flows of orders, right? So large flows. This is the basis for higher time frame bias, right? So depending what macroeconomic factors are indicating large flows will lend well to the higher time frame bias for the monthly and weekly charts being higher or lower, right? And so once we identify that, I guess this was a more unique scenario this past week. We had seen an election, and so pretty much that election really acted as a valve, right? When the expectation of Donald Trump becoming in office, that's when we really started seeing volatility flood into risk on assets, right? Bitcoin, all-time highs in both Nasdaq and ES, right? Gold taking a step back, dollar seeing uh, strength again, right? Um, we see markets coming alive in situations like these, right? And so that, admittedly, I'd had a short bias from a technical stance, but when you take into um, the changing economic factors and expectations of not just a few people, but of lots and lots of money and orders, that is going to change the large flows, and thus your higher time frame. You have to adapt, right? And so we switched midweek from bearish to bullish. Now, sort of go over that if we have time, but continue on with the example from the higher time frame bias. The stage, I guess you could say, would be set for a draw on liquidity higher, right? You'd be looking for that draw on liquidity, of course, to be to the upside, right? And so if you're looking for that draw on liquidity to the upside, your pro higher time frame trend will be looking for buy side liquidity, right? Anything that is counter to the higher time frame, will be looking for sell side. Um, I guess delivery would actually be a better term. Liquidity, right? And so once you have that, I was going to say something. Oh, right. Okay. And so really the model is inside of this path, right? Basically, the sequence that will arise, or the natural order of this dynamic, is higher highs and higher lows, a bull market, right? This is where you get market structure from. This is where you get the sequence of low resistance liquidity runs, right, of one-sided moves. It will be tied, it will be linked to this, right? And so this is, of course, a fractal. You may have a fractal inside of this. You may have a fractal inside of this. You may have fractal again in this. Right. And then again, you may have fractal inside of this. Inside of this. Right. Same thing over and over again. This is where we form intermediate term highs, taking out sell side liquidity for retracement, and then we find a fair market value, then we reverse and trade higher. But all that is really to say that this is the basis of when we look at a chart, where are we in terms of the sequence, right? Have we just traded off of an initial impulse after a period of consolidation? Have we retraced into a previous leg in price, and then we're looking to make that next symmetrical leg? These are all things that we'll have to consider. Maybe not so much um, systematically, like it's not going to be defined. This is a lot of it is experience and intuitive skill. That's how I've best derived how to find it. Right, the market is going to have its natural tempo, its natural cycle, right? And there's lots of studies you can do. You can study Gann theory. You can study Larry Williams things. Right? They all give some useful insights, but it's really, that's the part that can't really be timed, right? You can have a broad, you can sort of have it in a broad spectrum of like 5 days, I would say, of some major turning point. And then for intraday or lower time frames, like the 6 hour, the 4 hour, those are really good charts. Right? It's always moving inside of one of these things. It's never doing anything else, right? Because you have it's seeking liquidity or it's seeking imbalance. Liquidity, imbalance, liquidity, imbalance. Liquidity, imbalance, liquidity, imbalance, right? One of the ways that we can define it specifically, be more refined in that approach, is the draw on liquidity, right? The draw on liquidity, right? Because yes, we are tilted in terms of large flows. We're tilted to the buy side delivery on the buy side, right? Large flows, large orders. There's going to be a imbalance in conviction tilted towards buy side delivery, right? That's a given, right? But that doesn't mean that there won't be smaller retracements. That doesn't mean there won't be sell side delivery moves either. That doesn't mean that every rally is valid, right? You may be catching this rally inside of retracement. You may be a week long, right? A week long is somebody that trades at the wrong time, right? If the time that the market is going to reverse is set for a volatility event at a certain price, right? Anyone, doesn't matter who you are, anyone that is willing to buy here will soon become counterparty liquidity to those that purchase at that the discount price, right? Because it's a zero-sum game, right? Those buyers that bought too early, they will eventually exit their trade with a win or a loss, right? And so if the draw is higher and the market goes up to here, once the market crosses, they're in a losing position. They are forced to exit their trade, right? It isn't until that point that the market frees itself up to move to the real draw. So that's why these are weak long holders, right, or early buyers. But really all that is to say the draw liquidity, right, will either be on the basis of internal range liquidity or external range, right? And the concepts that we will go over today will assist in really identifying connecting these ideas to time-based sponsorship. Right. So what that really means is that we have, of course, we have like the weekly range. We have monthly range, weekly range, daily range, and session range. All right. Each of these have an open, high, low, close, or open, low, high, close. Right. This is a bearish bar, and open, low, high, close would be a bullish bar. But really, what we're focused on is the, how do I say, we're looking for that low resistance liquidity run. It gives us a nice one-sided delivery, right, within this bar, right, or within this range. This is where we hunt opportunity, and we do that based off of the time-based sponsorship, right? That is linked to whether we are drawing currently to internal range or external range. So in a way, you can say that this draw on liquidity, this would be your stage. Time-based sponsorship, this would be your setup, right? How is the market forming that candle? How is it going to engineer and neutralize to create the open high or the open low? The condition, is it time to see a certain event happen? Is it more likely over one or the other? Economic calendars, these all go into setup. Then the execution would be condensing it and timing it, right? Time of day, things like that. Time of day, I'll say PD array matrix, price. Right. One of the things that we will talk about today is linking both of these time of day and PD array matrix into a single concept that I call session range projection. Right. And this will be utilizing the overnight session, or I guess you can say Asia session, to create a stronger bias for time-based sponsorship for session and daily ranges. Right? So with that in mind, we have pretty much everything here that we would need. Take a screenshot of that. And so moving over to here, actually we'll go to a new example or an old example. So I want to think about the session that we trade is from 6 a.m. to 12 a.m. And this is just a very broad marker. If we use this 6-hour chart, there's 4 6-hour bars in a single 24-hour period, and each of those bars contains a session. So it's natural that in the pursuit of identifying a session bias, we would use a 6-hour bar to identify that open high low close or open low high close. Right? That's really all that really is. Right? So this is why I marked the midnight open and 6 a.m. open. I delineate time starting from 6 a.m. Right? And the natural, I guess you can say, trading time would be after the first hour. The portion where you want to be mainly done for trading is the last hour. Alright, so condensing that out, 9 o'clock is in the middle. It's a natural split between 7 and 9, and then 9 and 11. Right? So that is within every 6-hour interval from 0 to 0, 6, 5, 1, and 3, 12 to 1, 15, 18. This one's a bit different because it's a lot of the last session, or it's cut short. But yeah, really the highlight is London and New York. Right. This is more so for settlement for the daily range. The session open, high, low closes will be mainly focused in London and New York, right, between these 12 hours. Anything outside of this is really for the daily range. This is engineering for the daily range from the open to the close to here. Right, because you have the open and the close. Here, that would be your open, high, low, close bar for the daily candle. Right? Which is not the focus of this video. The focus of this video is focusing on these sessions, right? And they can work together, they can blend together. That's how they're meant to be utilized. But we'll just isolate it first, and then once we understand the concept and practice it enough times, then naturally it will just flow really nicely together. Right? So the session projection, or the projections that we use, is going to be within the first 6 hours from the open to midnight. Right? And really all it is that we're taking the highest high and the lowest low. And I don't really care for using 1801 candles high or anything like that. Very simple. I'm just going to use the highest high and lowest low. Simple rules on a 5-minute chart. Right, we can use this and then go to 555. And then we'll do the same for the bodies. Right. And so I went and created a template. So I typed these out. Very nice addition by TradingView. But really, we have negative deviation. This would be negative here. Negative deviation and positive deviation. And the B stands for body, and the W stands for wicks. So, this is something I've not seen before. Yes, we know how price can cluster around these levels. It can sort of act as a transposition for PD arrays on a higher time frame. Yes, those are all things that are true, but the problem that I see is that it's very subjective. Like, if you're looking at the first deviation and you find a discount array, which anything below this would be viewed as a discount, your first impulse would be to look at this as a point of interest and then to try and buy inside of where time is allowing you to buy, right, at this discount. But if you're creating your session bias off of that, then you're missing out on the link between these other ones, which is obviously where price is trying to go to, right? So if we are in the understanding that the price or the market is just traded from external liquidity above here, right, and it's trading internal range liquidity, right? Then we have potential candidates inside of this, right? That would be the first marker. Right? We wouldn't necessarily view this as an internal range liquidity target. It may happen. Yes, in this case it works well. But I'll show you how we can actually be a part of that move instead of looking at it just after the fact. Alright, so for each of these projections, it creates a natural wick, or it creates a natural bar into the future. And we can utilize this bar as confirmation or to negate ideas. Right? So if this was to be seen as a candidate for a bullish open high low close bar, right? We'll create a candle like this. Okay. So let's say that this, from the highest high or the highest body to one projection up of that body, right? Same thing for the wick. The wick is transferred from the high of that body to the high of the wick, one body, or yeah, see number one, that will create that first candle. Number two, same thing, we'll be starting from here to the number two's body. Number two's body extend to number two's wick. Alright, same thing again. 2, 3. And then 3, 2, 3. And obviously it's not practical to go and do this every single time. But you can see how it naturally extends further and further through. So it's going to take a great deal of money for this to actually unfold in price action, for the market to actually reference these PD arrays here, the highs are referenced in close proximity to the projected highs, right? So I'm really talking about these. It will take a while for the market to first breach it and use it as resistance turn support. Same thing for here. Highs are referenced in here. We have this order block inside of this. We can refine that down to this inverse fair value gap. Right? Same thing we would expect resistance turn support inside of these sort of projected ranges, right? This is a spin off of implied dealing ranges. Because if the market is going to trade to this high, this would be an implied range from there to there. We could continue on doing the same thing. So these highs here, same thing again. These highs here. That's what we would expect to unfold in price if buy-side delivery was in the cards for the market, right? Until a certain point where it would fail and the price would sell off again, right? Under the basis of, right, and this works in concert with the higher time frame big picture, right? If at this point in time we were bullish for large institutional flows and price was aligned in pro-trend environment, this would be something that would be considered, right? But since we are targeting internal range liquidity, this entire thing is part of a more complex pullback, of a more complex retracement and consolidation. So it's not going to be drawn higher at this moment because it's targeting internal range liquidity, right? And so that's the context behind what the market is trying to do at the moment. And so would we use these projections at the current moment? Yes, it's good to study, but no, that's not what we would use. We would go on the opposite side and use these ones, right? So yeah, obviously first, the number one range that you would want to study off of this projection is the one that's actually delivered in price, right? We had an imbalance right at the open, created a strong down close candle overlapping these lows. Market attempts to trade into those close, fails to swing up there. We take out this high, we break down, and we create a stop run, and then we create a breakaway gap, and then we trade lower, right? Breakaway gap is very key in this sense. But let's say we're trading London session. This is all that's available to us. How would we go about identifying if this is the current draw, or if this is the current draw? Well, imagine this as a candle. Imagine this as a candle, something that's familiar to everyone, to us. From one candle body to the wick, right? If this, right, and so at this point we have a context to apply these PD arrays now, right? So let's go to 1 hour real quick, just to so let's see what we have, right? So we have an inverse mitigation block. Right, that's the first thing that jumps out at me. So inverse mitigation block, basically this old resistance turns support, this support turn resistance. Right, that's pretty much the whole idea. PD arrays, they can either act as a draw, they can act as a means of identifying a reversal, or they can be used in this case where it's just a sketch, right? It's a sketch to identifying something that should take place, right? In this case, support and resistance. So this can be support or inverse mitigation block. Support broken, turn resistance. That's how they read it, right? RBS, SBR. Support broken, turns resistance. Right? So if that's the context behind this, then once we go down to the 5 minute again, how can we utilize this projected candle range to filter out and to view that, right? So what did we actually have in price? Oops. Again, what did we actually have in the market that presented? Well, we had this, again, the concept of weak shorts, right? Anyone who is short inside of this, their stop is above here, stop above here, stop above here. Right? These are weak shorts. Right. Right, creating a strong high, right? Creating a run on liquidity, run on stops. So we have engineer, neutralize, distribute. How are we just delivering? Can we see potential continued delivery from this high? And that's sort of what we have to ask, right? What things exist inside of this? We have the opening price, first hour, right? And so when we're looking at this, again, this range is potential support broken turns resistance. So we see it acting as support on the high initially. That high gets broken, 110. So the next means or logical point would be the mean threshold. All right. What reaction do we see off the mean threshold? If this is a support turn resistance, we want to see this get broken. We want to see this get pierced and traded through. We want to see this reference point of that opening price act as resistance, right? Sensitivity around that level. Now, what anchor can we anchor this point to? We have the opening price at midnight, right? And so we're always just it's a back and forth of something that's projected and what's delivering in actual price action, right? Same thing with this. If this is a wick, right? This is a wick, then the market should have relative ease to trade through it. And for further gradient, we can use each point of this as that. Right? The main ones that we're going to want to focus on, of course, is these ones. Right? So as price trades through, right, we break through that. We break through that. We pierce into this lower portion. And so creating a standard deviation of expected delivery, or maybe not expected delivery, projected delivery, down to the second wick. Let's make sure this is accurate. Okay, so from this to this, 2B to 3, or 2B to 2, 2B to 3, and then 3 to 3. Alright, so the same exact thing goes for each of these. Right? As the market breaks through that, we want to see this act as resistance. Opening price should be sensitive. Right? Anything that trades above here should be viewed as a potential change in state of delivery, right? Change in state of delivery. These bodies act as potential change in state of delivery. Now, when we have a candidate for change in state of delivery, We also have the candidate for that to fail as well, an inverse change in state. Right? So basically, as the market trades into this, we want to see this act as a bearish order block or market maker's sell model, and then collapse itself on itself. Right? So how do we see that reflected in price? Price trades down, breaks through this low, trades above this candle's opening. Right? We see short-term retracement. I remember how we talked about this in this instance. Yes, we would be trading pro trend or pro higher time frame, but the context of what is underway right now in terms of price delivery continuum or top down, right? It's a daily candle. It's a daily candle that is poised to move lower. This rally from 6 to 9 really means nothing. It's only 3 hours, right? So what is actually going on is that we have, again, this candidate for potential change of state delivery, fails and turns into a market maker sell model. We don't even reach up to the opening price. We reach into this upper quadrant up here. Market cannot even close above. And then we see selling take place. Institutions start to sell inside of this. And so continuing on with the narrative, we have equal lows here. This should send price below this candle's body and below this mean threshold. Right? These nest really well together, so that could be a drawn liquidity. Same thing with this and the low, number 3 to 4. Yeah, from 4 to 4. Right. So this would be our take profit zone. If when time aligns around 10 o'clock, 12 o'clock, we trade down all the way to the low of this. Almost perfect, near perfect. Right? 1 to 2 pips off of that delivery. But we can see how we have the conjunction, the close, or the conjunction, or not conjunction, congestion. Remember how he said that the last 6 hours, that portion is more tied to the close of the daily range. And the close of the daily range is going to be a natural retracement consolidation, right? And we do that once price breaks through below the mean threshold of this. Not mean threshold, consequent encroachment of that way. We trade below it, -4 here, creates a short-term low, and we trade higher, consolidate around here. Ends up being very, very nice. We trade up above this. This idea is repeated. So, yeah, you can imagine how powerful this could be. But like you said, it's really mainly used for session. Right? You don't really want to be tying daily candles to something that is based solely off of this. Right? It should complement. It should be easy to identify one of these things. Right? I'll show you an example of something that's mixed. On Friday of last week, we had not inside day. We had taken previous candle high and then we had traded down. So the daily candle is really uncertain. That daily high was really the only thing on the chart. All-time highs was that all-time highs? Yeah, all-time highs are there. So these two reference points were really the only thing. And so when we go do that same concept or that same thinking for this, we're not necessarily trading higher at this point. We can expect a measure retracement. We get that measure retracement in London session. Right, using that same idea, market has an initial reaction off of this. Well, what happened in here? Well, we have a contraction off of this high. Market trades it from this high at the first hour. Then we break down. Market makers sum of all this liquidity is here. Right? Market cannot break through any of these. Right? So really, we'd be waiting for displacement. Right? Displacement happened off of this high. It didn't reach into any of these points. Right? But when you think about it, when the market failed to reach up into this, that qualifies this as a bearish order block. Think about a rejection block. If the market trades to the rejection block, that's a less likelihood for that to play out because it's something we don't want to see, right? So when the market creates this gap in between here, there's still room higher in the future. Yeah, if this was an expected delivery, that failed, and are more poised to go lower. All right, inside of this, what happens? We have this high. Inside of this, BPR. So we can say with confidence that sharp traders are above this point. Right, market goes down. Using these same ideas, these lows should continuously break through if we are really going to see a deep retracement. But at 6 a.m. we see a reversal. Market failed to go through here. Instead, candidate for change of state delivery. Candidate for change of state delivery, what's in proximity to an actual shift in market structure. Well, we have inversion for value here. We have another one here. Right. This candle low should be broken through. Instead, we trade back above it. Using that with this change of state delivery that's developing, right, we have these two price points that we want to be on watch for. This is PD array, or the gray pool PD array that ICT pointed out. This could be one of the ideas for a long setup, right? If you're looking at the market, if you're hunting the market from 7 to 9, let's say that was your window. 7 to 9. Alright, again, what do we see here? Weak longs. Weak longs engineered, we neutralize at this point. Change the state of delivery, retreat back above the projected low. Alright, shift in market structure occurred here below. We have a gray pool here. This macro really delivers this low. Low gets rained and then reclaim here. shift to market structure here, inversion gap this. You could buy, be a buyer here, stop below this, targeting internal range liquidity, or like a low hanging fruit objective. Alright, 1 to 2 is all you need. That could be your setup. But let's say that wasn't. Let's mark out time of day. So 7 to 9, 6, 9, 11, and 12. So at 9 a.m. we start seeing this low get ran here. Still respecting all of these things. This is a short-term low traded above here. So is this a market maker sell model? They're going to break through here. The market failed to break through these projected lows, right? In the same way that it returned to deep discounts inside of this. And so if the market starts to turn, oops, and we have time of day 9:30. The market has just been bullish. Opening range gap. There's another reason for another trade here. All right, market books to that. Instead, opening price of this contraction. We trade above these highs. But this is a situation where the daily is unclear. You're gonna have to be more nimble in your trades. Really, the session or the time frame sponsorship would be like something like the hourly. Here we see the hourly down close candle. It's sort of matching how this looks in terms of range, but we can see how what it did. Let's just create this 3 drives lower into this BPR. Right? And it's not perfect, but this is a BPR. It overlaps heavily with the bodies on that change of state delivery, the projected range. And then we trade higher. So yeah, that's how I use these things. I think with time it'll get better. This is the day before we had a nice example, this one. The market just traded through and through and through. That's because the daily, the last portion, the daily and the sessions were both aligned. So 3, 9. I got the first hour and last hour. Right. We're going to sort of see how the unraveling of this range happens at these key times of day. And you reach all the way up into this portion. Right. So imagine this as like a wick. Trade up and up and up through that. Closing basis. Market trades up and up and up, and then we close. Okay, so I think that's enough for today. Yeah, it's really interesting. Something when you look at a lot of data sets like this, it can be very, very confusing. But once you put your mind to work in complex scenarios, then when you get to the live market, and you're only focusing on one bar or 1 2 hour setup, it becomes very, very easy and very possible to project a fluctuation in price, right? What you're doing here is that you're reducing the algorithm to a sizable chunk or a sizable piece of order flow. And you're doing it with risk parameters using PD arrays and time of day to in sync with the overall narrative. So hopefully you find this useful. I think it's very good information. I mean,